week's podcast episode, we're titling this What Critical Financial Controls Must Startups Have? And I'm thrilled to introduce Nicole Fernandez McGovern, President, RCM Financial Consulting, and a board member. Her previous executive roles include CFO and board positions in early stage public and private companies in various technology focused industries. Nicole has extensive experience in various aspects of finance and accounting, including capital raises, SEC reporting, accounting operations, auditing, data analytics, and financial planning and analysis. And I'm so thrilled to have you on the show, Nikki. We go back a long, long way. The entire McGovern family. I've seen all your kids being born and grown up. So thank you. I know this is going to be a tremendous, tremendous episode. You're going to share your wisdom bites for our audience. So thank you, Nikki.
Thanks for having me, Richard. I appreciate it. Same here. Goes back a long way too.
Awesome, awesome. So Nikki, let's kick it off because on one of my other episodes, I really talked about getting your accounting house in order, but it really was for more strategic events. This one here is really focused on startups. And as you and I know, 90% of startups fail, probably 10 to 15% in the very first year, if not more. So this is critical to get startups past that early struggle, right? And the financial controls and processes are critical to that survival. We're going to talk about each of the areas, but from your standpoint, what is the importance of establishing strong financial controls, systems and processes in startups, especially in the context of safeguarding company assets, Nikki?
So most of the time when someone says, and hire someone like myself for a startup, it's usually that they want to go to the next level. So what does that mean? Most of the time they're looking either to start raising capital leading from an angel investors and kind of going to the next level. And it could also mean that they want to go public at one point. But for all startups, they're looking to obviously raise capital in a manner that their investors are going to require some financial controls, right? They're going to require some type of mitigation of risk and understanding what exactly are you doing in terms of safeguarding the assets. So when they come, most of the time to me, a lot of times either they're starting on QuickBooks. QuickBooks is the beginning of all startups. And I always remind everyone, QuickBooks is not a bad thing. It really isn't a bad thing. There is things you can do around QuickBooks, right? To bring in those financial controls that let you pursue an audit. And that's really most of the time. They're coming and they're saying, how do I get audit? How do I prepare to undergo an audit, right? What do I need to do to get there? And most of the time they do have some type of financials, but most of the time they don't have any type of delegation of duties. They don't have any processes documented. They don't have any, they usually have maybe one bookkeeper in the background. Most of the time they don't have any type of financial controls. Of course, they also don't have any type of GAAP accounting, any type of framework that leads them to go and undergo an audit. So they begin first and foremost of saying, really where we begin is, what is the goal, right? And what do you want to, what is the goal? What are we trying to do here? And most of the time they'll say, well, I think we need to go through an audit. Okay, what do we need to do to get there? And most of the time it's obviously simple things like closing the books, simple things like just a reconciliation.
That's right.
These things sound very simple, but many times that's not what we do. The most many times these startups, the most they've done is close a bank reconciliation. And here's the fun part. There's others that they haven't closed their bank in like 12 months. And those are the ones that you just start, oh wow, we gotta start here, huh? And just closing cash, because at the end of the day, Richard, cash is king. Cash always will tell you if anything has happened in the background, whether it could be any type of fraud implication, whether it could be any type of you haven't done something correctly, cash. So you always start with, have we reconciled our bank account? Okay, great. And then from there, we go what we call it like a clean balance sheet approach of we're going to go one by one by one. I will tell you the hardest ones probably, and I've been doing tech now for a while, is anyone who has inventory. Those are hard. Those are hard audits because most of the time They're not sure what exactly is the current inventory they're using. They obviously have everything very commingled, and that becomes a very hard audit, just anything that has to do with inventory, because at the end of the day, they have to understand what's obsolete inventory. And that's another thing, just trying to explain to those new, to those founders what you're trying to do. Most of the time they look at you like, no, 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 just get it done, get it done. But the problem is you kind of usually do need their help to get it done. And
Absolutely.
that's the part where it becomes a little bit harder of trying to get them to understand, like, no, I kind of need you to help me put in the controls. And that's kind of where we start kind of going a little bit back and forth in terms of starting those controls, processes, and procedures. But unfortunately, at small startups, it does kind of include those founders. And they're usually hesitant or don't like establish any type of policies and procedures. To them, they see it as a very invasive um, to them, they see it as invasive, and sometimes they can get, it's kind of interesting and tricky because sometimes you have to tailor to them, but at the same time, you have to guide them and kind of in a way that they don't feel threatened by it, for lack of a better word. But honestly, trying to help them understand that you're helping them put in controls to mitigate risk, to then be able to go on to raise that capital. That's a
Understood.
lot of it. Alignment and just so it becomes a little bit of a teaching experience.
Of course. And Nikki, 100%, starting off by defining your financial goals. And you've touched on a lot of points there, which we're going to go a little bit deeper. But let's start with one of the big ones, which is why companies fails. Because is profit the same as cash? Now, what we're going to talk about is the runway now to get them, through that early struggle, Nikki, and to put them in the best position to survive. And cash, as you said, and financial performance is critically important. But one of the reasons why startups fail and other companies fail, they believe profit's same as cash. Is it the same or not?
No. And that
Okay.
is actually, that is one of the biggest, I would say, misconceptions. But at the same time, again, we go back to communication, alignment, and terminology, right? Like I have even most recently in the latest startup that I'm working with that's honestly going to go probably onto like a smaller mid-sized company, burn. The
Yes,
word burn. Well, what is my
absolutely.
burn? Well, what does that mean? What is my burn? And so having them understand what their burn is and what their runway is, and not only that, understanding how much should I have of runway. You can talk, some people will say 12 months, some people will say 18 months. I've seen it, for me, obviously I'm a CFO. I'm always going to say you should have 18 months of runway. The problem with that, Richard, is with these startups is they raise, let's say, $10 million in one foul swoop, and they think, oh, okay, now I can start increasing my spend, which then, by the way, if someone forgot to tell you, uh, shortens your runway,
Of
right?
course.
And so when you go back to profitability, that's another point of conversation, right? In terms of what is your profit margin, right? And then you've got all your OPEX, which then leads you to your burn. So, and then some others will say, well, I would like to know what the gross burn is. Well, what's the gross burn? That's just the OPEX. I just want to know how much my gross burn is. Because obviously in these high startup environments, high growth, the revenue isn't necessarily there. You're hoping you're hitting that addressable market. So you're taking that OPEX burn and then you're projecting out the revenue and the margin, and you're hoping you get there, and that hopefully is extending your runway. But guess what? Sometimes you fall short. And upon falling short, that's where the failures start going into play. Either you're raising capital consistently, which is a very time consuming task, or you're running out.
100%,
That's
Nikki.
the
And even if the startup is growing, Nikki, that can be dangerous because growth mode doesn't necessarily mean profits and therefore cash. In growth mode, in significant growth mode, there's usually a cash drain. And we're going to talk a little bit about the cash conversion cycle. But those are some of the indicators that startups must be very careful. Profit, a QuickBooks P&L statement doesn't mean to say you've got money in the bank account. And then
Right.
number two is even if you happen to be one of the lucky startups who can get off the ground and grow quickly, that doesn't mean to say you're going to have cash in the bank at the end of the day because there's a conversion cycle. We're going to talk a little bit more about that. So I've heard some of the foundational financial controls that every startup should consider when setting up their financial infrastructure is clearly define your financial goals. You mentioned, cash flow, daily cash reporting, perhaps a 13-week cash flow. What about budgets and forecasts?
So that also becomes a little bit, I think when you're first a startup really small, you don't see as much a budget, but you definitely see the forecast, right? Because at
Yep.
the end of the day, you're raising capital and everyone wants you to understand what is the addressable market opportunity here. And of that, how much do you guys, in terms of the startup, how much do you guys believe you're going to be able to acquire as that startup, right? So they always want to see the biggest TAM available to that startup, but at the same time, what is it that that startup is going to acquire? So many times they're not as detailed the forecast as one would think. They kind of start at a very, very top, very summarized level. So you're not necessarily saying of my SG&A, you're not necessarily, I'm going to hire 50 headcount in year one, 100 in headcount in year two, or, you're not necessarily going down to that granularity 3-5 years out, right? You're looking at probably, to be honest with everyone, and every once in a while I get asked, like, can you give me the 5-year, can you give me that 5-year forecast, that 5-year strategic plan? I'll give it to you. I'm happy to give it to you, but it's not real. It's not, there's not, going out more than 3 years for a start, a high, that's not realistic. I think at the end of the day, you're given the opportunity to come up with a forecast of what you believe you're going to get in the following year. And for startups, you're given a little bit of a forgiveness in the sense of, okay, you said you were going to get $50 million and you really only in year one got $20 million. Explain the why. You're kind of given that forgiveness for maybe that first year, sometimes maybe that second year. But after that, now you're going into straight forecast budgeting. And now there is an expectation that you start budgeting, hitting your budgets or close to it. And if not, hitting your forecast and explaining why, the accuracy of your forecast is no longer there. There is maybe a couple years, and I just don't see, it used to be, Richard, that you could go longer, especially if you were a healthcare company of continuing to burn and not necessarily hit your marks anymore. I don't think the forgiveness is there anymore. I think companies and investors want to see you hitting what you say you're going to hit and in a more relatively short period of time. So I'm seeing more pressure for more forecasting, more budgeting much earlier in the startup phase than I used to see when I started this 10 years ago.
That's interesting perspective. Nikki, what about the basic AP and AR controls? When you're in startup mode, which ones would you put in place? Which ones would you say are critical at that kind of?
So I think AP is more critical than AR. I
Yep.
always, because that's where your cash leaves. And so as a CFO that comes in, the biggest thing is making sure that if it's not me as a fractional CFO, if it's not me, it's that president of really looking at how that cash goes out and who that cash is going out to. So allowing that staff accountant to go ahead, put the list together, but making sure that you're approving and really paying attention, not only to, okay, these are the 10 vendors I'd like you to pay, but you should be clicking. And the great thing about banks nowadays, just pay a little bit more to your bank to help you with your controls. Why do I say that? It doesn't matter if it's Wells Fargo, it doesn't matter if it's Truist, just pay the extra fee. And what that means is your staff accountant's going to go in there, they're going to put all those ACH payments, and you, Richard, as the founder, you're just going to approve them because you saw the list. You said, go ahead and pay these 10. And now take a minute extra and make sure that what you're actually paying to the vendors is exactly that. Why? Errors can happen, just clean little errors, just a finger by mistake. And then at the same time, if there's anything that you see is going too much to a vendor or who's this vendor, you're going to be able to catch it right there. So to me, AP is critical. Not that AR is not, but APs were more volume of transactions. And then as terms of the AR, I think that's important, but I think also making sure what I think touches that control is your sales reconciliation to your books. What that means is what you're representing in terms of sales really actually is what you're seeing in that P&L. And if you're off, why am I off? A lot of times it'll have to do with AR, something didn't flow through the system properly. And so maybe they did a journal entry to the AR. You don't want journal entries to AR. You let your system work the best to its ability. If there's some type of a reconciliation, you'll see it there with that sales to P&L. And if it's not agreeing, then they're booking something to AR. You don't want that. That's where you need to start looking at that. You don't want it for the AP either, but for the AR, you need to make sure what's coming in is really what's coming in. And so I go back to the banks. The banks are great. If you make sure you have the least amount of checks coming in, and the more you have deposits coming in via ACH, which I think is a beautiful thing, less risk. Less risk for anything, less risk for the month. Plus, by the way, in terms of just the turn of how quickly you're getting your cash, you're going to be much faster, right? You're going to get your cash faster. It's going to process faster. You're not going to be worrying about this. I can't tell you how many times, especially with multiple locations, I'm sending 10 emails because I had a customer send a check. Oh, I sent it here. And then, nope, it's not that. No, I really meant here. And you're just tracking down a check. In the meantime, you're losing time on that deposit. And as a startup, 9 out of 10, you really need that cash.
Absolutely. And of course, you know, with some of the automated features you're talking about in the treasury system, you can eliminate the instance of fraud because, you know, there's lack of segregation of duties, which we'll talk about afterwards. But, you know, that automated closing the gaps, you start to, you know, strengthen the controls and eliminate any instance of fraud. All right, let's go. Okay, and then you touched on an important point, Nikki, because, you know, you're a fractional CFO in your current role there. How important, and you've got typical staff accountant or the founder's aunt or the founder's brother or sister who are doing the books and records who may not be qualified. How important is an early stage to seek professional advice and maybe get, you know, someone who's overseeing the aunt or uncle bookkeeper or whoever to make sure things are done well? What would you say about that?
I mean, at the end of the day, I think that in terms of, look, I think I don't see the aunts and uncles. I definitely see the spouses more
Yes.
than I definitely see the spouses, and that's where it can get a little bit hard for me and for my purposes in terms of, I think there's a point usually where you want to ask the spouse or the family member to take a lesser role. And that's a little bit of the tricky part, right? But you hope that maybe some of those conversations are had early on. Usually when they're coming to someone like myself, they know that this is a time and they've had those conversations as a result. I mean,
Got
so
it.
I do think it's important. And because I think I've never been a fan of, you know, a lot, and so a family too mixed up because I think it can cause, you know, a little bit of hurt feelings along the way. So I think a lot of times these conversations are had earlier versus not.
Perfect. Okay, let's go into cash flow now. We're going to go deep. Cash flow management is crucial for startup survival and growth, Nikki, as we both said, right? Can you share some insights and potentially even some tools on how to control cash flow and the role in financial stability? And let's talk about a few things like the 13-week cash flow, perhaps getting to break-even point. You mentioned burn and cash runway. I want you to kind of define what you mean by that so people can understand those, and the cash conversion cycle. So let's take one at a time. 13-week cash flow, Nikki.
So that is the one thing in terms of the cash flow. The one thing, and I have to tell you, still to this day, even with mid-sized companies, the one thing every single founder will understand: cash.
Right.
If you tell the founder, look, you need to stop spending, they don't usually take that very well. They get a little bit more like, but I don't understand. I'm raising $10 million. I'm going to raise another $50 million. If you do not take it, and I am very clear on this now, and put it into a cash flow to show them how quickly that money runs out, they do not understand that. Now that they understand in 5 minutes flat. So unfortunately, you've got to constantly, and I call the word constantly, Richard, if not on a weekly basis, constantly be doing cash flow. You know, I started Elizabeth Arden And obviously I started as, a finance manager and kind of made my way up. And what I used to do daily, and back then we didn't have as much software and we didn't have so much, but we did what was a daily cash balance. We reconciled the cash daily. We had a revolving line of credit because we were heavy inventory and we were very seasonal, obviously perfumes, very holiday based when you're building things. And so every single day we were running the cash and we were managing that cash literally on a daily basis. And it didn't matter. Even when I left and we were a $2 billion company, that cash was managed daily. I think with startups, the problem there is the resources, right? You don't have the resources. But I have to tell you, I think it should be almost a weekly thing because it is the same. I don't think it miss. And so that cash, even for our CEO, obviously, who stopped eventually at a $2 billion looking at it, that they were still looking at that when we were a younger company at Elizabeth Arden. And I started there and we were like $200 million company. But everyone understood cash. Didn't matter. Everyone sat at the table. Everyone understood whether we had to restructure debt, whether we had to bring in on more debt, however it meant was cash. Well, I think with the startup, it's the same thing. I think it becomes a cash flow that you need to constantly start looking at. And the other thing is, when you're raising capital, not necessarily when you decide, oh my gosh, I need capital right now, that doesn't work like that. So you need to give yourself runway and you need to give yourself time to be able to go back out depending on the time of the year. So understanding that cash flow and consistently updating the cash flow based off of your revenue, the cash that you've collected. By the way, that's another thing as a startup, you don't technically have a lot of times that pull as a larger customer does to get that money in the door. So sometimes some of your customers are not as forgiving in the sense of you see them, oh, I'll get you next week or the week after. Well, that presents a strain to you as a startup. So that being said, I would say, and now really looking at it the way it is, if you can do, obviously, if you can do daily, most of us cannot do daily. Just again, they're usually small companies, they're resource constrained. But honestly, weekly, yes. And you update the scenario based off of that forecast for the next 12 months. You update any sales, any type of collections, and then you basically start continuing to look at that trailing 12 months. You will say 13 months. Honestly, Richard, I always look at, 1 year plus 3 months. I try to look at it in that way. So for right now, for example, with the startup, I'm already looking at Q1 of 2025, right? So we're kind of always trying to go out as much as we can, and updating based off our cash scenarios.
How important, Nikki, is getting to break-even point and understanding what your break-even.
So that is the new thing. And I have to tell you, that's the new unicorn. That's the unicorn. If you talk about the unicorn in a startup, that's the unicorn. Growing and reaching break even, now you're a unicorn. And that's to me the unicorn. And that's the one that everyone's looking for. How do you grow quickly? And can you grow quickly? And what does that break even point look? With this new company that I've recently started working with, that has been the constant question is, Nicole, when do you guys reach break even? Nicole, when do you reach break even? And I have to say, I can tell you when you reach break even. There's a couple of different things, and that includes me working in the background with a lot of the other executives. They have, for example, chief growth officer. I actually really like the chief growth officer I'm working out with this current VC-backed company that I'm working with. It's a startup. And understanding kind of certain scenarios in terms of when the customer is going to come in, when it slides. I call it slide to the right. What does that mean? It means I didn't lose the customer. It just slid in terms of its start. And then not only, by the way, I have to understand, I signed the contract today. That doesn't mean the revenue comes in the door, Richard. So that cash flow gets a little bit more complicated, right? And so, great, we signed the contract in December, right? But I still might not get cash in the door from the customer, and one of them in particular till July. So each one looks a little differently. And so you kind of looking at that and understanding that and really understanding the dynamics of that is really important in terms of how I look at the cash flow. But that break even becomes important. So when I go back out and I say, When do you believe, Nicole, you're going to reach break even? Ideally, Q2, but could be Q3. So I always say ideally, because ideally, my financial forecast is saying X, but if certain things slide to the right, it could be Q3. Now, it shouldn't slip in my mind. Then if it starts slipping and it's no longer Q2, Q3, and I'm saying 2025, Richard, then there's other things in terms of my forecast accuracy that something has gone wrong with the business. And that being said, that's really important because obviously as you start also growing in terms of the OpEx, right, based off of certain metrics you hit. See, that's the financial discipline that a lot of times I see these startups lack, right? They just say, well, I've raised X, I need to put it to work. I have all this money, I need to put it to work. So I'm going to hire, 30 headcounts because that's going to get me more speed in terms of getting my goals. That doesn't always equate like that. That doesn't always work like that. Doesn't necessarily mean your customer's going to work faster and say, here's the additional revenue. In the meantime, you're burning faster. And when you burn at certain levels, you'll be out of cash much quicker than you anticipated. So financial discipline is really important. But I'm going to say right now, if you're that startup that can not only grow and show significant growth, but at the same time, have that financial discipline to hit that break even, you're a unicorn.
Nikki, you mentioned burn rate and cash runway a couple of times. Just define those quickly for novices who may not understand what.
So for runway is how much, and it's funny, that's always, how much cash do you have, Nicole, until you run out of money? Which means literally you have no money to make payroll. And I will tell you, as a CFO of startups, there has been many of nights where I do not sleep very well because I am worried about making payroll.
Yeah.
I worry less for myself, but I do worry for my employees, right? So that is very stressful. Very many of nights with me and the CEO that I've worked with in the past in various companies where how much till you run out of cash? That's your runway. So you say, I have a 12-month runway. The problem is you could say I have a 12-month runway, but if you don't hit certain financial goals in terms of your revenue, and what does that mean? There's two things to the revenue. One is obviously, Richard, just getting the contract. Mm-hmm. Two is when can I start billing? And then I'll add a third one. Did I get the profitability with the customer that I wanted to? Because you're a startup. You don't necessarily get to control getting that margin because you're not the lead in the room, right? You're coming in a little bit as the underdog. So sometimes you come in a little cheaper. Now, the idea is not to continue to come in cheaper, but sometimes you come in cheaper. But if that profitability is less, then obviously I'm going to end up burning more cash. So for you, those of you who don't runway, that is how much do you believe is your runway? And that does change. So again, going back to that weekly cash flow, my runway can be 12 months. And the next thing you know, this didn't happen or that didn't happen, or it moved to the right in terms of collections or so forth. My runway is now down to 9 months. And that makes a big deal. In terms of burn, we talk about that all the time. And so if you're pre-revenue, that's just basically all the different costs, right? That's it. You're burning $1 million a month because here's my development costs. If it's a tech company, if it's, I don't care if it's a pharma company, here's all my costs that I'm spending, my IP costs, so forth and so on, facilities, so forth and so on. I'm burning this a month. When you do have revenue, then we're going to look at, okay, revenue, less your costs, that's your gross margin. And let's say you make $100,000, but your OpEx is still $1 million, you're burning $900,000. As clear as that.
Wonderful. Well said. Thank you, Nicole, for clearing it up. Brilliant advice. Now, how important is it to understand the cash conversion side? You mentioned contract to receipts. And if companies have got inventory, to your point about Elizabeth Arden, there's a point of how quickly that or not quickly that may turn. And then you got days payable outstanding. There's a gap that has to be financed. And small businesses, particularly every business, not just small, but particularly with small businesses who don't have that luxury of runway and, extended burn and all that kind of stuff. We've got to understand what that gap is. Tell us a little bit more about the cash conversion cycle.
So every business is different.
Yes.
And also depending on the customer, right?
Yeah.
If you're dealing with a government, obviously, I think the cash conversion cycle is very long. And Now, the good part is once you have it, once you're kind of working your way up, what I mean by that is, let's say you've got, 4 or 5 of those government clients, and then you're kind of, collecting, and then it's got a, but it's got a 45-day collection, right? You're not going to see it in 30 days. Sometimes you're not going to see it for 60 days, right? And that's just the way your contract reads and so forth and so on, depending on that. Other ones, they're pretty quick. And other ones, let's be clear, as a startup, a lot of times you're selling to other startups, so they fall a little bit on distress moments where they're saying, well, I can only pay you half. And you're like, well, I kind of need the whole, and it's due 30 days. So you end up going like on payment plans, even sometimes with some of these other vendors. In one of my other companies that I sold, we did a VAR, which was a value-added reseller. We never sold direct to the customer. We always sold to the VAR. Some of the VARs did great. Sometimes you want to go into some of these countries, so underperforming countries, and you want to sell into certain countries, but the problem is a lot of times they're smaller, more regional value-added resellers, so they don't necessarily. So what happens is I'm selling to the to the reseller then has to sell it to the customer. The idea is the reseller should pay you right then and there. Sometimes they can't. They are making you wait till they're able to sell it all the way through to the customer. And if they're selling it through to a government or a university, you got to wait till they get their paycheck to then give you your paycheck. And that is very painful at times. So you start learning who pays, how they pay, and then sometimes you have to decide, is it worth it to keep that customer, because it's too much of a cash outlay in your part, because you're putting if in my other company, right, it was a drone company, you're putting the cash outlay to work all the capital resource, and then you're waiting much longer than you anticipated, and so you have to then start managing that in terms of the customer. Is it worth it? Is it not worth it? That becomes a big part of it pretty soon, because that also causes you to have certain financial constraints. So really understanding that, and that goes back to even building the forecast, right? Most recently I was building the forecast for this company, and when I updated the forecast, really updating the forecast really meant updating when do I think the customer cash is going to come in through the door. So although I signed 3 contracts, Richard, in December, I have it probably the 3 different contracts, the cash is coming in on each in a very different way. And it's the way the contract's written, the size of the customer makes a big difference. The bigger the customer, obviously, the better they're going to pay. But sometimes the bigger customers will also, in the beginning, make you go through a lot of bureaucracy to get a good established way to get that turn, that cash turn. But once that bureaucracy is kind of established, then okay, I'm doing better. But I do call it all hands on deck of focus on this customer, this large customer. Let's figure out exactly what we need to do in terms of controls internally, so that we don't get hung up in their cycle, right? Because you can get hung up in their cycle. So that means internally, we've had to recently change some of our controls internally to make sure that we're getting paid on time, because if not, it gets kind of stuck with approvals, for example. And that's why, because they'll say, well, Nicole, you didn't give us that invoice in the way that we described in our contract. And we're like, but we think we did. And they're like, no, you didn't. And so you'll go back and forth and back and forth. And until you have that discipline and financial acumen with them established, now your turn is taking longer. So that is a big problem. And so when you're doing your financial forecast, great, I'm installing certain pieces of equipment at a certain period of time, but what does the contract say in terms of sign-offs? And then what are you doing internally in terms of your controls to make sure you get those sign-offs? Because person B in customer success, do they understand that until we get this other person to sign off in the customer success team, do they understand I won't get paid? Do they really understand that? So having those meetings with operations, which I had one even on Friday with the operations team for alignment, is very important, because I think people need to own the process. And I think that's one of the biggest things in going back, Richard, to like you're saying, well, what is runway? What is this? Well, there's a lot of discussion in me educating, let's say, our operations team. But quite honestly, Richard, me too. I need to understand certain things like, oh, I didn't know that's what that meant. I was confused. and I thought this meant this for this customer, and I thought it meant the same for this other customer. And they'll be like, no, this customer, that means whatever point it meant in the contract is different than the way it meant in this other contract. So really owning the process and really getting some of those disciplines and getting some of those controls and processes set in place between operations and finance so we can invoice, that will affect your turn. And you need to spend the time and the effort doing that, or else it will hurt the business. And the next thing you know, you get the CEO screaming, "What?" And you're just like, we're working on it.
It's a brilliant, brilliant point, Nikki, because I tell you one thing, I've often pushed the adage to all organizations that I've been with that revenue is everyone's business, because people often think, it's a critical, business process. People think, oh, you got a billing department over here and you got the one person over here who's collecting money, that it's the financial organization's problem, but it isn't. Because along the way, to your point, that billing process starts all the way from the front end, all the way to, billing the billing department and the collection. So along the way, that complete alignment's got to be there. Because to your point, one little mistake on a bill or you've misinterpreted a contract means a longer period before an even longer period before you collect. And nobody wants to be in that position, especially when you're burning cash.
Correct. And sometimes you upset the customer. Because then they
Yes.
start thinking, well, you guys can't do it right. And so you're like, well, we can't do it. So that internal alignment is really important. And I don't care, Richard, obviously, industries are different, but healthcare, healthcare is the same. Obviously, my husband being a CFO, all I hear is the revenue cycle management. So whether it's healthcare, whether it's, SaaS, whether it's hardware, whether that term is important. But I think the biggest thing I'm seeing, especially with these startups, is alignment with the other key executives. I think is really, really key, and understanding what they're saying to me and then what I'm saying to them, and then trickling it down, right? Making sure that my team understands it, that your team, Richard, in operations understands it, that the chief growth officer understands it. It really does begin with first of us having the right conversation and then deciding who else, in terms of what I call our L2s, are they having the right conversation? Because if not, also you end up wasting time and you end up not getting the outcome that I think everybody wants.
Absolutely, Nikki. Well said. Well said. So let's assume for a moment you got a great staff accountant, produces, these financial reports, a 13-week cash flow, simple P&Ls, balance sheets, and so forth. So let's assume there's fairly good financial reports spitting out a system. What simple key ratios, Nikki, can expose if there's an issue?
So, I think one of the things in terms of, for those of us who have inventory, I think the inventory is really important. And looking how many days, you have that inventory on hand. Because I think there's a little bit, COVID did an interesting thing to even startups, right? And it's the startups, we don't have the buying power that obviously an Amazon has, for example, but we don't have buying power. So then it became a place of how much do you buy? And so how much inventory do you have, right? And then what I think we stopped paying attention to a little bit as we came out of COVID was, wait a minute, do I really need to have a year of inventory on hand anymore? Can I go back to just in time? I don't think for certain key components, I tell everyone, rank your inventory as 1, 2, 3. What is just in time? Literally, I just go in, type it, overnight, I got it in 2 days. What has a little bit longer of a lead time, whether it's 30 days, 60 days, and what is the key components that you really want to source a good amount of them and have maybe 6 months to a year out. And then obviously purchasing power, right, does come into it, because if you don't commit, you're going to pay a lot more for these startups. So going back to just simple inventory turnover ratios are really important, and just really understanding that. I think really understanding in terms of, straight, like, again, ratios that I look at is customer acquisition costs is important. I think with startups, you have an issue of trying to grab as much revenue as you can whenever you can, and it doesn't matter the cost. And sometimes it matters the cost and it matters the lack of focus. And that one might not be a KPI that I know, but I think sometimes we just start going after everything, every which way, and that becomes a problem in terms of a lack of focus, right? You've got your team running here and running there and so forth and so on. And was it really ever worth it? So prioritization in terms of how we're going to go after different markets, I think is really, really, really important for startups, because you're trying to get as much revenue as possible. But what does that look like? So going back to that, is the margin there? Is the amount of revenue worth it? I mean, these are very simple. I call it, a lot of the times is, Richard, and I do say this with the startups, is let's just look at the fundamentals.
Yeah.
Like, let's just look at the basics. Like
Yeah.
you said, this podcast of, can we just look at the basics? And a lot of times if we go and look at just some of the basic accounting rules and accounting metrics that we did as most of entrepreneurs that our parents did, just, is it worth it? Is the lift worth it? And so a lot of times I think we forget that. And that does feed into how we're looking at some of these financial ratios. So really, I think the acquisition costs, and when I look at the acquisition costs, obviously there's a nice ratio to it, right? And so it's very easy of the ratio. But do you understand the time that's involved to get that customer? And is the customer going to give you quite enough revenue? Sometimes it's better to focus on 2 or 3 large opportunities and maybe let go of some of the smaller ones. Again, everything has to be looked at in terms of what you're looking at, and is the margin going to be there? Sometimes the margin's not there, but you hope you can have that customer love you and renegotiate the margin later, which that I've seen also, right? That's really important. Like maybe you just do a portion so that the customer falls in love with you. And then next time you go back to that customer and then you're saying, hey, I gave you a deal the first time. I know you loved my product, but this time I think I need a little bit more of a margin, and here's why. Let me explain. And so those types of discussions and negotiations are really important. So constantly understanding, what your margins look like, what your acquisition cost looks like, and then what are your retention? Are you retaining your customer? Are you being able to upsell your customer? That's really, really important, because if you're starting to have customers leave you and you're not retaining those customers or being able to upsell them, that is a key indicator as a startup. Something's wrong with the product.
Got it. Brilliant. Love that, Nikki. Love that. Just a couple of liquidity ones, and again, assuming your staff accountant has a good set of financials, your current ratio, current assets to current liabilities can expose something, as well as the quick ratio, those readily convertible to cash relative to your current liabilities is also probably a good indicator as well. But I love customer acquisition, margin at a unit economic level, because you really see whether that unit, that product, whatever, is really making money or not. And
Right.
sometimes that gets disguised as to what you should be selling more of or less of, and where there's potential hidden issues. Great. Okay. So one of the assumption is startups obviously heavily relies on external financing, Nikki. How can they ensure transparency and accountability when dealing with investors, lenders, and other stakeholders while protecting their own interests? And I'm talking about the type of reporting that goes to these other stakeholders. Just what are the table stakes, Nikki? I mean, clearly there's basic financial reporting. There could be some KPIs to your point. There could be some operational reporting. What are the table stakes?
Yeah, and it's interesting because I wish there was like a perfect book on that, right? I've come to the conclusion that it really does depend on the investor.
Yeah.
I have to tell you, even most recently, I've had different calls with different types of investors in terms of what they each want to see. And they're all different. I wish there's obviously the table stakes that we've talked about throughout this call, right? There's just the normal, like I'd like to see financials, right? And I'd like to see how much cash you're burning. And I'd like to see a balance sheet. And I'd like to see how much debt you have on the balance sheet. Obviously, any types of how much liabilities do you have on the balance sheet, right? So I'd like to see that, because obviously that's great. I can give you that P&L, but obviously if I've got a big, large payable and I've got a big debt that might have a balloon payment, you're not going to be very happy, Richard, with me, because obviously I might make it look like I have a great runway, but then you're like, oh, well, yeah, sorry. And on month 13, I now have to pay 5 million of debt back. And so you're not too happy if I just cut that off and didn't tell you that story. So that's kind of important. But I think really and truly, I've seen ones that they just only want to look at revenue growth. They want to look at operational, they want to look at those margins increasing. Really, where I'm looking in terms of table stakes right now, everybody's very focused on that break-even question.
Yeah.
When are you going to break even? I will tell you that's probably the biggest one I'm seeing. And I'm even seeing with opportunities of turnarounds, like companies that had profitability and were able to, really have that that I call it free cash flows, that have stopped generating free cash flows. Well, how do I get back to free cash flows? And what do I need to how do I need to get there? And if that means you might have to get rid of a piece of the business, but I really, really look at some of the measures and metrics here in tech. The biggest thing I think they look at tech is that ARR. They really want to understand that ARR. I would say in tech and the car. Those are the two biggest ones, right? Like, what do I have today contracted and what is that ARR look like? Really understanding that, I think that makes a key determination in terms of valuation, right? Two things, and in tech also the profit, the margin, right? Because initially at the beginning, going back to that customer where you had that acquisition cost that was a little higher, two things as you grow. Hopefully you're being able to negotiate better contract terms, but at the same time, are you getting those operational efficiencies, right? To increase that margin, because that's what they also want to see. They also want to see that, are you increasing your margins? Are you getting to the margins that we believe? Now, I will tell you, we have these conversations a lot of times with the VCs. Well, I think you should be 90%. That's great. I don't know how many companies are 90% margins other than Slack or something like QuickBooks, right? Like, you're talking those unicorns in and of themselves. So those are not necessarily realistic either. I think level setting those expectations are important, and understanding why, the financials are going to have a certain story, specifically with tech. Making sure that your investor understands your business, right? Why it's still a great business, but understands why the margin is going to be X versus Y. So I do think we focus a lot on that, and then they'll look at some of them as you get a little bit more. They'll start saying, okay, well, what's my AR ratios? Again, those inventory ratios, really understanding, and then they'll even start talking about, debt, right? Can they, as they generate free cash flows, okay, should we start taking on more debt? Because now the investor is focused on, they don't want you going back out and continuing to raise capital and dilute them.
That's
so
right.
That dilutes them. So that's another big key indicator. So you start seeing a bunch of different ones depending on who the investor is.
Right. And ARR, MRR are just recurring revenue metrics, just for the audience who may not know that.
Yeah, ARR is annual recurring revenue.
Yep.
MRR is monthly recurring revenue.
Right.
And that is when it's very important for the audience, because that's the contract that can go 4 or 5 years out. And that's a contract that's based off of the customer says to you, ultimately, okay, great, I'm going to pay you $2,000 a month for my subscription for the next 5 years. That's right. If you take, the 2 times the 12, you get a certain number, and then the monthly is $2,000 a month, and for how many years? But that's important, because that also shows a certain financial stability to the business and making sure that you keep those customers.
That's exactly right. And then there could be, may not necessarily be all startups, but there could be some type of leverage ratio if they've got debt on the books, right? Some type of.
Yeah, and that's an interesting one, because I do think obviously with debt being so costly right now, it's a little bit tricky, right? So you have to kind of play with that. But I think also at the same time, in terms of with a startup, obviously there's valuation points. And the only way you can raise a valuation point is obviously usually something has to happen. A catalyst in the business has to happen. So what does that mean? I signed 2 huge contracts. I, got this great customer. So something had to have happened from the time we raised capital, let's call it Series B to Series C, and the valuation has to increase. So usually your investors that came in on, let's say, Series B, they came in at a certain valuation. If you would need to go out and raise capital now Series C to take the company to yet the next level, they want to make sure that the valuation goes up. They're not going to want you to keep going out. So then what happens is, obviously we need cash to still continue. So many times I think that's the opportunity to start looking at that debt and say, well, how can I bridge it based off of that MRR? Because a lot of times banks will go ahead and give you a revolving line of credit based off of those contracts, right? Because it's cash that they know that is coming in every single month, and then you service obviously the debt based off of that, and it's a ratio. I call it a borrowing base.
Yep.
You run that, and it tells you how much you can borrow every day, and based off of that, you can kind of maybe bridge yourself because you know, like, oh, okay, I know Richard in 3 months I'm going to sign this big contract, and then my valuation is going to go up exponentially, and then I can go back and raise capital. So really looking at those debt options, I do think is important, and understanding those debt options with whether it's venture capital or whether it's just a traditional bank, right, based off of the MRR. And so sometimes, obviously, you can do equipment financing. If you have equipment, by the way, if you're a company that has a lot of equipment, you borrow based off of the equipment that you have in hand. That does help kind of bridge that gap in terms of that next capital raise. That way you get the higher valuation. I think that's when you start looking at it. Granted, Richard, you know better than I, when the money is cheap, because debt is cheap, obviously we should all kind of start looking at that. But right now, money is expensive. To be clear, money is expensive no matter what. I don't care if you're raising, capital equity wise or you're raising capital debt wise. Money right now is expensive to raise, but nonetheless, obviously we need to grow and we need to move forward. And especially if you've got a good, if you've got a good company, you got to take that to the next level.
Perfect. Nikki, is there at startup phase, is there, one report which is more important than the other? Let's take the P&L, balance sheet, cash flow. Is there one that's more important than the other, or are they all created equal?
Cash flow. Cash flow. They are not created equal.
You've been consistent.
Cash flow.
Okay. So the cash flow statement, 13-week cash
in
flow.
startup world, cash is king.
Perfect. All right, you made that clear. Okay, let's talk. So we
now, granted, the P&L feeds the cash flow, to be clear.
Right. No,
so everyone doesn't think that my P&L doesn't feed my cash flow. But the forecast, so it does begin, with the P&L and updating that cash flow, updating that forecast, right? And then based off of what I speak to, and again, really looking at your other officers, it is important you rely on them, right? It is important you rely on some of the assumptions that you're making. So that means it takes time, right, Richard? It takes time for me to get on the phone with my chief growth officer. It takes time to get on the phone with my chief operations officer. It takes time to then, can't even tell you how many phone calls of my chief operation officer says A, the other one says B, and the other one says C, and the three of them are saying something distinct. I'm like, all right, everybody, we're having a three-way phone call because this cannot work. So making sure everyone is saying the same thing, because by the time I present that to the CEO, there has to be alignment between us and the assumptions we're making internally, and then it'll feed the cash flow. So you do have to start still with the P&L to then update the cash flow, but usually and truly, cash flow.
Perfect. You've been consistent. All right. So we've talked a bit about process. We've talked about technology. You mentioned QuickBooks, and there's banking treasury systems which can help a startup. Let's talk about people. So startups may not have dedicated finance organizations, right? So how can they effectively manage financial controls without a large team? What are we talking about? When at startup, we usually start with what? We'll start up maybe with a bookkeeper, maybe a staff accountant, and they need people. And you're exactly hit it on the first point, which is what are your financial goals? Because if it is to raise money, maybe do venture capital, maybe go the equity route or the public route, things have got to start. You got to start preparing your talent, but you don't have the money. You're burning with development. You're burning with customer acquisition, and yet we all know entrepreneurs tends to look at the financial organization as, they're off on the side and they got to give me these financial reports, etc. Tell us a little bit about investing in talent early on in a startup phase, and how do you balance
You
entrepreneurship
know, I have to
with
tell you, that's one
discipline?
of the things that sometimes disappoints me most about founders.
Yeah.
I now worked with somebody that I met in Elizabeth Arden for 20 years. And she left, obviously, she stayed at one of my old companies, and 20 years. She does not have a degree, but Richard, she works hard. I find she's very talented, and yet, and she's good at what she does. So I think finding those key people are really important. This company that I just started with, I find the team is really important, and I really like this team. A dysfunctional team can break you. And when
Yes.
I say that, by the way, at the executive level, I think people underestimate that all the time. I find it, I call it the shiny new ball syndrome. And that syndrome says, oh, but I have this person. And please, boys and girls, I do not have anything bad if you went to Harvard or Stanford or any of those schools, but it doesn't mean that the rest of us aren't doing a good job or don't have good financial backgrounds and acumen to do just as well. And I understand the schooling is important, and I understand a lot of things are important, but I think really getting the right people involved can sometimes be great, and other times it can be highly, highly disruptive, and it can kill a company. It really can. And the next thing you know, you've wasted a lot of time and resources to that. So I think really understanding the company, the stage where the company is at, and bringing the right people that, for me, and I think Richard, you and I have talked about this a lot, just as much as I want to work with great people like yourself, I want to work with great people under me. I learn from, right now I'm working with a new team. I could not have done the transition with this new team if it wasn't for the controller and that manager being able to be transparent and share. And yet sometimes what hurts my heart is sometimes because they're just the doers, like my other person that I've worked with for 20 years, we don't value them as much. And the next thing we know, we don't pay attention to that as much. And I think that's a little bit sad that we forgot the people that got us, the startup that got us to the next level. Let's just try not to forget that. I do think that one of the things I value about the CEO that I work with at Elizabeth Arden is he from Canada came. We were a bunch of people in Miami Lakes, and for those of us who do or don't know, it's a very Latin part of Miami. All of us, you know, very loud, ran bunches, and we were a small company, 100 million. We left 2 billion. He valued it. He valued that team. He took them all the way to the end, all the way to the end. They all became millionaires as a result. I think we forget that at times. And so really making sure you've got those key people that are doers. Just because they're not screaming doesn't mean that they shouldn't be valued. And that also is important, that the teams you bring in, as you bring in new talent, and I do think you need new talent. I want to be clear. I do think you need new talent, but make sure not to disrupt what you've got going. Because if you got to a certain level, let's make sure that at the end of the day, it'll be part of your culture and where you need to go into the next level. So I've seen that throughout the ways where it can really hurt companies, and other times if it clicks and it works well, it's actually quite a beautiful thing.
Understood. No, 100%. That institutional knowledge, as well as you mentioned, Nikki, is critically important. So, but give some advice to the entrepreneur who's, got no one. He's looking to make his first few hires. He's going to hire all of the right salespeople, marketing, operations. Now he comes to finance. He has no idea. He or she has no idea about the financial organization. What would be your advice on the kind of profile at startup phase that entrepreneurs should think about hiring? Just the kind of profile. What would they look for in it? Because I've seen startups, again, friend of friend of friend, aunts, uncles, this and that, who have no idea about debits and credits and everything else.
Yeah.
By the time you roll around, the books are a mess. So if they could start from scratch, Nikki, what would be your advice on the right profile to hire?
So it's interesting you say that, and the right person, and the first thing that comes to mind is flexibility. And that's the first thing that comes to mind. I think, and then a doer, are the two things that come to mind. Flexibility with a doer. I think startups sometimes, obviously, we want people that obviously come with a certain financial acumen, obviously a certain background, and again, we go sometimes after those pedigrees versus where the stage of the company is at that moment in time. And so I think when you're a startup, I think you need to be flexible. I think you need to be dynamic in a lot of your responses. And I would say your models have to be dynamic, Richard. So God help if you're not dynamic, because your models are changing every 5 seconds, because that's startup. There isn't, Richard, I was at Ryder, and at Ryder we set a budget once a year. We set a strategic forecast once a year. And then all we did was do actuals and update, that 1+ budget. And then that was it. And maybe a couple of conversations. So that is a very mature company. And obviously with a lot of great, smart people at Ryder to this day, but not in terms of the startup world, you need somebody who's going to be dynamic, but at the same time, I think has enough of a background to really be able to understand how to have a conversation and really relate why, the value of the company to investors, to Wall Street, if that's what you want to do. So it's an interesting person that you have to go out there and find. But I think at the end of the day, for startups, I think you have to have someone that I think is flexible and can roll up their sleeves. That's really it. If you really think about those two things, and if you really get that person that's able to do that, I think you're in a great spot for a startup.
Awesome. Awesome. Nikki, you mentioned communication, transparency a number of times and alignment, and I wholeheartedly agree with you. And you also mentioned the fact that entrepreneurs and early starters don't kind of necessarily understand the need for financial controls, or they want to burn money, they want to add all these developers, etc. So how can startups ensure that everyone understands and follows established financial controls and processes? And then I'm going to do a part B around that, about articulating financial results. But let's start with the first one, because typically no one wants to have approval processes. I don't want to go through this one and that one. I just want to go hire the person, and I want to do it quick. How do you articulate and align an organization to make sure that they understand and follow the established controls?
So I think that's always been a really big challenge of mine, honestly, Richard. And I think initially when you come in, people usually, in terms of your establishing those controls, are not usually thrilled with adding those processes, and they see it as me, Nicole, wanting more control,
Yeah.
and you just want to be the person to control everything and to puppeteer everything. And the answer is no. That is not what I'm here to do. That is not what I want to do. That is not the goal. The goal here is to be able to put in, to be able to speak to the investors, to be able to take the company to the next level and set certain financial parameters, certain framework. I call it the framework that allows the growth to come in underneath it and quickly. So because I can't go backwards, I can't grow at a $50 million company and then have everything broken and then try to fix it. That is such a disruption. You guys will never live through it. And then, by the way, I don't have a job because that was my fault. So really and truly setting those frameworks, but I think alignment has to start obviously at the top, understanding, having those key conversations, and then going to those L2s, and I call them the L2s, who, by the way, if tomorrow I'm gone, I want my L2 to take over, Richard. I want to have shown them enough truth, transparency, everything, and really coach them to the next level. Because that's another part where I really think is important. So at the end of the day, so that each one of us, whether you, Richard, the COO, me, Nicole, the CFO, are telling everyone, listen, we are all aligned with growing this company because the success of this company will be all of us beneficial, right? To all of us. And so at the end of the day, this is what we need to do to get to that 50 million. So you've got to give people a little bit of visibility of what is that pie in the sky that we're going for. I don't think you burden them. That people always say, oh, truth, transparency, I want more. I think there's a level of how much you want to share, because you also don't want them burdened, or you don't want them to lose focus, but you do want them to understand why they're part of getting really the success of the company, right? And if they understand that and they can see, like, this is my top goal, kind of sharing with them what I call an investor deck, which is kind of very top level of why should you invest in the company? Well, why should you be an employee? Why should you work harder? Tell them, make sure what Richard is saying as COO is the same thing that Nicole is saying as CFO. And that will help, because you're never going to control the chatter. The chatter is always going to happen. And as long as Richard's saying the same thing in a closed room that Nicole's saying in a closed room, and then that their L2s is saying it the same thing to all the different employees, I'm telling you, you guys are going to be in a better spot for it. And I think that's really what it comes down to, is hiring those people, but you do have to get buy-in, but at the same time, need them focused and not worried, because some of the things that comes with startups is a lot of stress and worry.
No, really well said, Nikki. And I love your point about, them understanding where they fit into the big picture, right? I mean, that really is critical, and we often lose sight of that. All right, so many folks don't know potential how to read a set of financial statements, or track the progress or articulate financial results effectively. What typically have you found in terms of a cadence, whether it's weekly meetings or the way you express or communicate financial performance for a startup company? Nikki, what are your best practices?
And that's another big thing. And I think a quarterly, they're called town halls. I do like the quarterly town halls. I think those are important. I think I've seen town halls done by CEOs in a different way, all the different ways. I think, and I'm going to say this in the nicest way possible, I think sometimes CEOs bullshit too much to their employees. Don't do that. They're not stupid. They give them a little bit of truth and transparency. They're going to be a little bit happier for it. So show them some of the great things, and then at the same time, tell them a little bit of what is the priority for the next quarter. I think that's important. Why? Because what we're going after, and hopefully at a startup, this is why startups, a lot of times you don't pay the best at a startup, but you give them all equity. Well, let's tell them how we make sure their equity is worth something, right? And make sure you tie that in, right? Because if you tie that in hey, if we close this next customer, we believe our valuation is going to go up. And I just did an equity grant for all of you guys. And you sell them on that idea and how we're working towards this one big goal, and how it hasn't happened yet. And these are the things I need, and the prioritization. Just give them enough, but don't overburden them. I do think that's important, right? And so share with your employees just enough to get them excited. A little bit of truth and transparency will go a long way.
Brilliant, brilliant. What's your personal philosophy, Nikki, on open book? How open book are you in the startup phase? The $1 million question, right?
I'm probably too open book.
Okay.
I am the worst poker face in the world. Everything is on my face. I am probably, if I go and work for any company, I usually believe in the company. I'm usually pretty passionate about what I'm doing in terms of my work, and I'm probably too open book.
But in terms of open book around sharing financial, sorry, I should have made it more clearer. Sharing financial results and so on. How open book? What's your philosophy around that?
Well, the thing is, Richard, remember, I've been the majority of my career, I've been in an SEC role. So what that means is everything gets shared. So whether I've been in a company where, yes, we're private for a couple of years and then we go public. So I've done that a good amount. But when we're private, we're a really small company at that point in time, and then go public. So in terms of the financials, it's all there. Now, I will tell you, even though we disclose it all, we share it up. Most people don't read it. It's a hard, I call it a very hard read. So most people, although it's there many times, and by the way, as sad as it sounds, Richard, board members will say, well, you didn't disclose this and this and this, Nicole. And I'll be like, yes, I did. Look on footnote 15, paragraph 3, it's right there. So those are hard, long reads. So I think summarization of the financial results in a way, kind of like a press release format, Richard, I think is the right way, right? It's the same thing like you do those earnings calls. Well, I think when we were Elizabeth Arden, we encouraged our employees to do our earnings calls, right? And that was letting everyone, right, know like how the company did financially. And then in terms of the town hall, when you're a publicly traded company, I think that town hall is a little bit more like, this is what we're going for. Thank you all to my employees, so forth and so on. But I do think I've never been anyone not to share, I would call it the basic financial. I don't see any harm in that, in at least quarterly. I don't think every month, because you do what I call soft closes in a startup, and they're so it's harder in a startup to do those really great closes. But I think quarterly, you ask your team to kind of really, really make sure that the P&L is as accurate as it can be. So that way, what you're showing everyone, including the board and your investors, is the same thing you're showing your employees. So I think quarterly is a great cadence for most.
Perfect. Well said. All right. We'll move quickly through the last 3 questions. And this one is, as startups scale, Nikki, the financial needs and complexities evolve, right? So what are some of the signs that startups should look for to indicate it's time to reevaluate their financial control environment?
So it's interesting. I think as startups, that's one thing. When you look at the financial control environment, it's also, I think it goes also with the organization, right? So what do I mean by the org? The org chart, Richard. So every time, and it's interesting, when I started doing a lot of these processes and procedures, I would get a lot of them and they would say, well, Nicole Fernandez did Miss Fernandez, and it's like, stop. We gotta just go by the actual positions. So really, when you start looking at startups, that constant involvement of the org, because that's one of the biggest things startups are doing. They're constantly hiring, they're constantly reevaluating the org. Well, upon reevaluating the org, you have to reevaluate the framework. So now the position that I didn't have, now I have. So now I got to reevaluate my controls and processes and procedures. And I think it's got to be reevaluated simultaneously with that org structure. And as a startup, honestly, Richard, I used to say yearly, every 6 months.
Yeah.
Every 6 months, you got to look at that org, and are you sure it's working? Are you sure it's not working? And then the other thing is, I've also come to realize, and so once you realign that org, like quickly, you got to look at how's that framework of those financials working, because sometimes the financial framework isn't working because the org is not working. The way it's structured isn't flowing correctly, and so it's breaking along the way, getting bottlenecked, or just not getting me the outcome I need. And a lot of times it's because of the org. So I used to say, oh, once a year. I actually think with startups, it should be looked at. If you can't look at it quarterly, at least twice a year, and really understand is your org working.
So Nikki, with an evolving and growing org structure, org chart, let's say, just highlight 1 or 2 controls that typically have to get looked at as the organization grows. Just give a sense of what are
I would
1 or
say,
2.
like, specifically, one of the orgs that has to be looked at all the time, honestly, AR, that invoicing process, that customer success process. Like, I can tell you that was probably the biggest one, because there's so many different hands that touch it and that yet can break it along the way. So I would say AR.
Perfect. I love that answer, Nikki. All right. Last 2 questions. What mistakes do startups make that may lead to financial trouble?
I raised capital A so I can start hiring 100 people as a result. That's all the time, every single time. Well, never seem to get away with it. And so you move the goalpost. Even though I agree with someone on this is what we need to do, you move the goalpost. I don't mind moving the goalpost, Richard. The goalpost always moves. It's startup world. It's when you move the goalpost by an entire football field. That's the part where like, I don't even know, I can't catch up. I can't catch up. And that's, I think because in startup world, there's a lot of great things that can happen in 1 minute. So in 1 minute, we're raising $10 million of capital, we're getting 10 new customers, and we're 2 minutes within signing it. And then the next thing you know, we start incrementing all our OpEx because we know X is happening and Y is happening, and you don't have enough time to really lay it out and really put it into a good financial model. And all of a sudden you've got 10 people hiring over here that didn't tell the CFO, and this person's doing this because obviously your CEO is going in 10 different directions. And then by the time the CFO gathers all the information, puts it all in the financial model, guess what? You're out of capital a lot faster.
So
CFO's fault, right? But it's just you're catching up because
no, it's brilliant. I love that. So Nikki, on that point, because you've talked about talent, raising money and then basically going gangbusters on talent which may not have been forecasted or planned for or whatever. As a pivotal role, as a CFO, what controls do you put in place to control or have the discipline around talent hires? And it could be a very simple system, but what do you do?
So I think the best thing, and I really go back to this, right? So going back to the one point is, I think a lot of CEOs think I'm going to fix it by more headcount. If I have more headcount, I'll fix my problem. I have to tell you that sometimes yes and no. So the answer is yes and no. So that's as clean as you can do. But if you set a budget in terms of I'm going to hire at least 10 headcounts at an average cost of X, right? And you try to keep to that. And if you can't, if for example, one of your headcounts ends up being more expensive for whatever the reason, right? Then that's fine. Then where do we find the dollars instead of, right? How do we balance our budget? How do you balance your forecast, right? And so I think that's what it comes down to. Like really and truly, it comes at the more important is staying within that budget and really quickly and truly really showing everyone on paper that's the best I can do, right? Is okay, I closed my books for monthly, and here's what we said was the budget. Here's what we really came in at. Did you hit it? Did you not hit it? And then honestly recasting. And I think that's what comes down to how you put in some type of control in terms of your spend. And are you hitting it? Are you not hitting it? Just because you raise X of capital, it doesn't mean that you have to use it all in one foul swoop. That's really what it comes down to.
Understood.
So the budget to me is a great starting place because that's what the board and everyone agreed to. And if it shifts, then let's just kind of all agree to it together.
Perfect. Last question, Nikki. What is your parting advice for establishing fundamental accounting processes and controls in a startup organization?
What is my parting piece of advice? Wow. In terms of fundamental controls, to me, the biggest thing is the treasury system. I would say that would probably be one of the most fundamental parts of if you're able to start there with that treasury system and when I say the treasury and the cash, and that includes the approval of just headcounts, right? I do think in one of my last companies, the board, in order to establish some controls within the spend of some of the CEO, they said, let's do a delegation of authority in terms of if it's over X or Y, we're going to approve it together, right? Why do I say 9 out of 10? I'm going to obviously approve it, whatever the CEO is kind of saying, but at least the conversation's there, the awareness is there, and I'm able to quickly update the financials and the outcome of that cash burn and not finding out a lot later. And that makes it a lot harder because by then sometimes time has passed and it's like, oh great, 30 days has passed and I didn't know I had now 3 or 4 new headcounts that I didn't have. So really, I think establishing some good controls in terms of capital outlay in terms of headcount, in terms of consultants, and in terms of any long-term commitments. And when I say that, right, you don't want your CEO running out tomorrow and signing, a lease for 10 years. And you're like, wait a minute, now I'm stuck in a lease for 10 years. And then you're just like, what just happened? So if you can have a good treasury controls and then also some nice delegation of authority where you guys have some checks and balance and where the CEO, it forces the CEO to have discipline and come to you and say, hey, I need this, I want this, and you remind them, okay, but if you do this, it's you usually as a CFO know straight off the top of your head, you're gonna throw the budget out of whack. Are you sure that's what you want to do? And the CEO says, yes, that's what I want to do. You advise them the risk, you advise them the implications of that risk, and then when the numbers come through, that's where everyone's gonna have to live with it together.
Brilliant. Nikki, this has been fantastic. We've known each other for a couple of decades at least. I've tracked your career. I know you're a tremendous business partner to CEOs. They're very fortunate to have you. You're an expert and you're the ultimate professional, Nikki. So this is fantastic. You've covered all the areas of how you start up in an early stage organization, an early struggle, and getting them to the next level. So thank you for this, Nikki. This has been great wisdom bites. Thank you.
Well, thank you, Richard. I enjoyed it and appreciate this opportunity to be here with you today.
Thank you very much, Nikki. All the very best to you now. Bye-bye.
Okay.